Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what the investors are thinking about right now and how that fits in with building the right portfolio. So since Liberation Day in early April, the global economy has been focusing on the tariff policies coming out from the White House. As the deadline was approaching on the 90-day truce on reciprocal tariffs, President Trump again announced additional tariffs on trade partners and really pressuring them to make trade deals. And since then, we have had a number of trade agreements, for example, with Asian economies such as Indonesia, the Philippines, Vietnam, and of course Japan, and at the same time with a number of other developed economies such as Europe. However, at the same time, he's threatening to increase tariff on a number of close trade partners such as Mexico and Canada. And the latest move is to actually add 50% tariff on Indian exports to the US. So what does that all mean in terms of the latest developments of these tariffs alongside with the macro implications? And of course, what does that mean for investors across Asia Pacific? I'm delighted to be joined by our global market strategist, Raisah Rasid, who's based in Singapore, who just co-wrote a paper on this earlier this week. So Raisah, thanks for joining us. We certainly have gotten a lot of information in the past 2 weeks, but still a lot of unanswered questions. What's next and what should we expect?
Thanks, Tai. So the reciprocal tariffs have kicked in at midnight on August 7th, the US time. Now this brings the overall average tariff rate to 17.4%. Just slightly down the road, while we acknowledge that tariff uncertainty has declined, the tariff uncertainty now relates to the eventual tariff rates on exempt sectoral tariffs, such as semiconductor, which has not been announced yet, and critical minerals, which are under the Section 232 investigation. Now, in India, the recently announced tariff rate of 50% is now planned to be kicked in just under 3 weeks from now, and this would nudge up the overall tariff rate to 17.8%. Now, what markets are waiting for is that are there going to be negotiations for a firmer bilateral trade framework before the end of the year between the US and India. On the case of China, we just came out of trade talks in Stockholm between China and US officials. Now, the extension of the trade truce is uncertain for now, as President Trump is weighing his options. But if the extension is not reached by the deadline, then the US tariffs on Chinese goods could rise back to levels seen in April, and this pause is set to expire on August 12th. Now, we're also looking towards the sectoral tariffs, as mentioned earlier, particularly on certain sectors. And, we've always said that there will be relative winners and losers, really depending if you're a half glass full or half glass empty person. But the impact on these tariffs could hit markets differently. So on semiconductor imports, President Trump has marked tariffs of around 100% based on press reports, though not firm, but plans to exempt companies that are manufacturing in the US or are planning to do so.
So let's move on to the macroeconomic data. Now, sentiment is a key channel where tariff impacts pass through to the economy. Back in April, some of these so-called soft numbers, such as business confidence, consumer confidence, they were flashing red and really highlighting the risk of a potential recession. So how does that change in the past few months, especially in relations to what we call the harder data, such as manufacturing production or the job numbers or consumer numbers?
Now, if you take a step back and think where we were in April, that peak uncertainty period, if you will, we were very concerned about the massive drop in sentiment levels from what we've seen from the soft data, as you mentioned. Now, we were looking at survey data coming out of the US. We were looking at consumer expectations, business confidence, such as the CEO confidence in current business conditions. But what we've seen so far is that despite the news flows in recent weeks, which one would have argued would be relatively negative news, sentiment has rebounded, although we should be noted that they have not returned to levels before April's Liberation Day, which really speaks to the fact that there's still much uncertainty around tariffs. Now, the concern for us, however, is that we could see the weakness in sentiment at that point in time translate into the incoming hard data. For example, the postponement of capital spending by corporates, which could be more disruptive for growth over the longer term horizon compared to the direct impact on tariff itself on growth. Now that sentiment levels have stabilized, albeit at lower levels, this informs our view of a slower second half 2025 growth for the US economy. Now, part of the reason why sentiment hasn't tanked could be because inflation has been relatively stable. Many reasons have led to why tariffs impacts are not very apparent in inflation yet, but we do think that it is a matter of time until we do see some heating up in the inflation data. For now, we do think that it's mainly because it's corporates that are bearing the brunt of the burden when it comes to tariff due to uncertainty and the fear of losing market share if they do proceed to hike prices, and they're still digesting the front-loaded import inventories. So importers and consumers aren't bearing a lot of the cost yet. We did see some early signs in the June inflation print in the core inflation, but we do think it's a matter of time before it's being passed to consumers. So we could see headline inflation rising towards the latter part of this year.
So bring all this together, what is our outlook for the second half of the year for the US economy? Are we expecting a recession or just simply slower growth? What's your take?
I think it's an interesting time to be having these conversations, about the softness going to second half of 2025. Entering the second half of the year, the view that we had was that we could face a slower second half, and that was a confluence of policies. When we think about immigration, fiscal policy, tariffs, all begin to bite consumers and corporates alike, especially when we consider the competing impact on growth and inflation. Now, what's interesting is that the slowdown that we saw through the massive downward revisions in the job numbers last week gives us evidence and confirms our view that there is that slowdown that we've been penciling in underway in the US economy. Now, in terms of Fed cuts, it is making the Fed's job a little bit more trickier. The central bank should be cautious in lowering interest rates as the sharp decline in labor supply with that fiscal policy that is going to come through will be more evident in terms of growth impact in the first half of 2026 could sustain above trend inflation as we enter 2026. Now, we could see some front loading of the rate cuts, however. But as long-term investors, the consideration that we should have is how do we allocate portfolios is really dependent on where would long-term rates settle maybe 12 months from now. And what we do know is that it's most likely going to be lower from where we are right now. Now, we can debate over the timing of these cuts, but this will very much depend on the incoming data that we see coming out of the US.
So finally, of course, what does that mean for investors? We've seen the market really was very volatile in April, but since then, a slew of good news, for example, strong earnings numbers coming from the US has allowed US markets to once again hit record highs. So where do we go from here and what should investors be ready for?
So tying all this together, more broadly, long-term investors should continue to be very mindful of the structural factors that we've been talking about, such as automation and artificial intelligence. AI revenue growth continues to justify the amount of capital expenditure. We think we're almost at the tail end of the second quarter 2025 earnings season. And while the fact that more than 80% of companies have beaten earnings expectation this season, what's even more comforting is the fact that sentiment or forward guidance by some of these large tech companies are now pointing towards more investments in infrastructure and talent, which to us is a nod to that powerful secular transformation or super cycle that is AI. Now, obviously, near-term headwinds, which we flagged before, dollar strength, tech chip restrictions, that's something we should look out for. But on those two fronts, on the first one, the dollar likely has some room for weakening in the near term, supporting some of the tech-related revenues sourced offshore. And when you think about the tech chip restrictions, we do think that some of the export controls to China is expected to relax to some extent as time passes on this year. Now, what does this all mean for investors? It suggests that they should no longer bet on a strongly rising US economic tide and really consider diversifying into other assets such as international equities, for which we're always looking for structural drivers. Now, active selection is going to be very key to identify key winners, especially in equity markets such as Europe, where fiscal spending is expected to pick up more materially, with banks also outperforming after decades of underperformance following the GFC and the sovereign debt crisis. Closer to home, corporate governance reforms and value-up programs in Japan and South Korea respectively could really improve the equity market landscape over time. But if anything, the power of diversification, which was illustrated in the first half of 2025 performance, where international equity markets outperformed the US market, is really something that we truly have conviction in.
So Raisah, thank you very much for your insights. And of course, thank you all for joining us today to understand what's happening with tariffs and what does that mean for investors. If you like this podcast, please consider subscribing. Of course, recommend this to your friends and colleagues. If you have any question you want to raise to us or you want us to answer, feel free to reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in the next episode to discuss what's on the investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.